I want to start broad here. I have a ton of ETF questions,
Sure.
but I'm going to try to restrain myself a little bit. Let's talk about what we've seen unfold over the past couple of months, because as you well know, there has been a ton of volatility in markets. And I wonder, how that is affecting what you're seeing when it comes to the product lineup, how clients are thinking about allocating and how their risk appetite has been shifting.
Yeah, well, first, thank you for the invitation. Thanks for joining us here in our offices. I think clients are, frankly, leaning into the volatility that's been in the market. I think they're starting to get a little more comfortable with volatility being a norm. And we're really seeing every client around the world, whether it's an institution or an individual, want to get more personalized about their portfolio and customize. So, things like taxes in the U.S. and how people are trying to manage them is really important, or inflation hedging. And that's why we're really focused on making sure we have a diverse range of products that can meet all those needs. And frankly, we just reported our AUM for the month of April, and we had about $20 billion of net new flows. So clients are active, but they still have some cash on the sidelines.
Absolutely. And getting clients out of cash, I know that has to be one of the conversations that you're having. I do want to talk a little bit about what's going on in private markets, because, you think about even before the outbreak of the war in Iran, that's what we were talking about, the SaaSpocalypse, if you want to call it that. I know that Invesco has been pushing deeper into private markets. You have several partnerships. Chief among them are your partnership with Barings. You do have one product in the marketplace that's live, but you think about what's going on with the retail investor landscape, some of the turmoil that we've seen there. Has that sort of thought prompted you to think about redesigning any of the planned products that you have, or the planned timing of those rollouts?
Yeah, so Invesco, we've been in private markets for about 40 years. We have about $135 billion in assets across private real estate and alternative credit. So we've been serving institutions for a very long time. What's happened in the last few years, as you know, is the interest of wealth managed clients, high net worth wealth managed clients, and now more retirement clients in their 401ks or other such plans around the world. And we've seen that uptake happen. And so what we've been focusing on is how can we create the right kinds of product strategies and the right kind of delivery, lots of education, lots of operational ease. And I'll use the 401k as an example. We just did a survey. 85% of plan sponsors and participants want to see privates in their 401k plan. And it really makes sense. I mean, target date funds are professionally managed. Assets are long dated. And if we can create structures that make sense for a 10 or 20% allocation, we just think that's good as assets shift from defined benefit to defined contribution plans. So I think we're at very early stages in the industry of this.
Interesting. So again, what we've seen over the past couple of months, not necessarily causing any sort of rethink or redirection.
No, not at all. I mean, look, investment quality and delivering in packages that make sense for clients has got to be the priority. I think what we're learning through this is a lot of education is needed as well. And that's a big focus for the firm. Whether it's individuals or retirement plans, education is going to be key.
All right, so let's get a little bit into ETFs, because I've been dying to talk to you about the QQQs. Of course, that is the Invesco Nasdaq 100 ETF. It's one of the biggest, oldest ETFs out there, and it finally actually is an ETF.
That's right.
A lot of people didn't know this, but it was a unit investment trust, and you finally, got the proxy votes to convert it into an open-ended ETF, which basically frees up a lot of money for you, because you don't have to spend so much on marketing, as was written into the prospectus. Talk to me about that process, because you think about the Qs, the number of shareholders you have in that fund.
Right.
I mean, it amounts to a small country at this point, I think. And, you had to cross the threshold of 51% approval from your shareholders, the ultimate exercise in herding cats. What was that process like? I mean, how much money, how many resources did you aim at just trying to corral all these votes?
Yeah, I mean, the Qs, as you said, is really an amazing flagship fund, not just for Invesco and our ETF franchise, but really widely held around the world. And it keeps growing. I mean, the assets in it today are around $450 billion. And the wider innovation complex that we have in Invesco around it is about $600 billion. So your point is, it's large and it's very widely held. And we were really pleased to be able to make that conversion happen in December. And it was a lot of work, but the shareholders in that fund, the millions of shareholders, voted to make that conversion. Fees are going to be lower for them. Of course, there is revenue for Invesco, but it's going to really enable that fund to continue to modernize and be the bellwether that it is. And we're really proud of that, and we're really excited to continue to take it to even more individual investors and institutions around the world.
And so I'm paraphrasing here because it is quite wonky, but the net effect of converting it into an open-ended ETF, again, you don't have to spend so much on marketing, and basically you're able to actually earn a revenue here because in its former format, you basically didn't see much revenue from that product at all. And it's interesting, since the proxy passed, since we saw the conversion, Nasdaq has come out and they're actually letting other firms license the Nasdaq 100. Invesco had the rare privilege of being the only firm in the U.S. to have a Nasdaq 100 linked product. And I would just love to hear your reaction to that, because obviously that exclusivity has directed hundreds of billions of dollars into the Qs over the past several decades.
Yeah, I mean, given the Q's size and its holders and everything we just talked about, and the 25 years we've been involved, I mean, we've built an amazing brand for that index and for the QQQ product, which is really one of a kind. And being able to continue to do that is really going to be our focus. The ETF trades with amazing liquidity, really tight spreads, not to get wonky back at you, but also it has $500 billion of notional options traded against it. So it has a lot there, but we continue to think it's going to be the bellwether. And as people continue to have interest in the U.S., large cap, largely growth markets, that's where they go. And they know QQQ, and that's where they're going to be focused, and that's where we're going to spend our time.
So not concerned?
We're focused on growing the Q's franchise. We compete with people in the ETF business all the time, and we've been able to grow that franchise to $1.2 trillion. And it's been growing its market share. So we compete on quality and differentiation and price and all those things. It's kind of par for the course.
Well, I do want to talk a little bit more specifically about your relationship with Nasdaq, because the theory is out there that because you aren't mandated to be marketing the Qs and by extension marketing the Nasdaq 100, that is one of the reasons why Nasdaq chose to sort of extend the licensability of the Nasdaq 100. And I wonder, what those conversations have sounded like with the firm.
The Nasdaq and us are great partners, and we have been for decades. I mean, we have dozens of funds, not just the Qs here in the U.S., but part of that $600 billion innovation complex. So we continue to look for ways to invest behind the Qs, both with the Nasdaq and on our own. We're going to continue to invest, and we said it in our proxy, upwards of $100 million against the QQQ, which is more than any ETF I think has ever had against the marketing of the index. So we're going to go from strength to strength. It's a great partnership.
Well, speaking of the Nasdaq 100, SpaceX is a company that could be coming public next month, and we know that Nasdaq is set to sort of fast track that company to be included in the Nasdaq 100. There's been a lot of consternation from that point, a lot of worries about what this will mean for the index and the products that track it, and I wonder where you fall on that conversation.
Yeah, I mean, the index providers and teams, they make the decisions about what's included in their index. We create ETFs around that index. We want to make sure our ETFs have the diversity that they're expected to have, do what they say on the tin, of course. And, the Nasdaq 100 is meant to include the biggest companies that are out there. So, as new companies get listed, we're big advocates for people going to market and the capital markets continuing to hum here in America, which means more listings, more IPOs. So we're excited about continuing to have that fund represent the best and the biggest here in the United States.
And Andrew, I do want to talk a little bit about you, because you have a really interesting resume. You're sort of a homegrown talent at Invesco. You've been here for over 20 years. You took over the CEO helm about 3 years ago. And in that time, I mean, Invesco shares have risen, I think, close to 120% on a total return basis. You're far outpacing your peer group. And I just wonder what, the next 3 years, the next 5 years look like for you, what you will be prioritizing, and what you want Invesco to look like going forward.
Yeah, well, thank you. I mean, we really have the benefits of an amazing foundation here at Invesco. Of course, we're a big global scaled asset manager. We're almost $2.5 trillion in assets under management. But way more important than that is how diverse the business is across active and passive, public, private, and now international is 40% of our client assets come from somewhere outside the United States, which is really important. And so myself and the team, we've been really focused, and we'll continue to focus in 3 main areas, and it's really around innovation, around clarity, and around delivery. And what I mean by that is innovation for our clients. We've been doing a lot on the product line, like we talked about, partnerships, and this personalization theme. And then in terms of clarity for our business, it's been a major focus. Let's just pick 5 things and really focus on those and sort of declutter the rest of the company. We've been divesting some things, we've been de-emphasizing some things, and making sure we have a culture that's collaborative and decisive. And so we've done a lot to simplify the business. And then, as you mentioned on delivery, first and foremost, it's for our shareholders or for our clients, pardon me. And it's been about delivering investment quality. And they've rewarded us with $150 billion of net new flows in the last 18 months. And for our shareholders, you mentioned it, but earnings were up 25% in the last quarter we reported, delevering the balance sheet and continuing to reinvest in the business while returning capital to shareholders. We've increased buybacks, increased dividends. So those things are the things we're going to continue to focus on.